There are only two reasons why you should get into shares or start investing in shares. If this is not one of your reasons, then please sit down and know that shares are not for you. I will also share with you in this video the strategies that you need to apply that will make you succeed in investing in shares in general, even as you begin this new journey. Everything needs a plan, and more so when it is an investment. You need a lot of clarity when getting into one. Let's get started, but quickly before that, if you're one of those who are watching but yet to subscribe or leaves without even a like, please niambie kusubscribe ni shingapi, ka like pia hivi, at least leo usiniache without, ama vipi. But it is so good to have you, and I hope you are blessed as you are learning. So the first reason why you should get into shares is for wealth creation through what is known as earning of dividends. This is basically using your money to open up a new stream of income, the money that you've already collected or the money that you have, by creating a cash flow. In simple terms, this is when you buy shares with the aim of creating a new income. Companies are in existence not to pray for people or help the less fortunate in the society or like just solve problems, but first to make profit or get return on their investment. The main job of a company CEO is to make sure that the company is profitable, and for that they get paid heavily. They are there to make the owners of the company some good money, ama VP. And if that's not the case, they are usually asked nicely to step aside, ama to leave, and someone who can takes over. So when you buy into a company, you automatically become one of the shareholders, or quite literally one of the owners of that company. Owners don't jump in today to wait for the next time that they are going to be jumping out with profits. Imagine James Mwangi of Equity running to sell his shares right now because Equity has grown by double, yes, over the last 1 year in share value, and he doesn't want to miss out in the profit-taking season. Ati wacha niuze kwanza hizi shares alafu I'll come back again. On the contrary, you will still hear that he bought more shares of the same company. But why do they do that? Because the goal is to grow his cash flow. He's earning from the company. Even as the company keeps growing and expanding, he also expects his cash flow to also grow. There is a famous saying that cash flow is king, and the wealthy focus on this principle to create and grow their cash flows. So usually companies do declare profits or losses at the end of their financial year, and as owners, there is a part to take some of the profit as dividends and have the rest to go into growth or expansion of the company as they have agreed, okay? And every owner or shareholder gets a fair share of the profit according to the number of shares that they already have. So if you didn't know yet, they divide the total amount of dividend or the portion of the profit that they want to share with the shareholders and divide it by the number, or rather the total number of shares in the company, and come up with an exact dividend per share that they are going to be paying. You will hear things like we shall be paying 2 shillings per share or 50 cents per share. And from this point, if you had 100 shares, you can do the math, Cindy, and see how much you made as your dividends. If you had 100,000 shares, you can also do the math and see how much you're going to go home with. And since I am seeing most of you saying you are diversifying and buying one share in 20 different companies because one your minimum, you can also do the math and see what you made if dividend imekuwa declared from that one share. Now, if this is the reason why you want to get into shares, there is a strategy to implement and help you come out as a winner. First, you need to have a goal in mind. How much do you want to earn as dividends? Your goal is to create a new stream of income. So what's your target of income? What is the goal? You need to be able to see what you are aiming at, because without that, it is impossible to come up with a plan for you to get to that point. The mistake that many people, many investors make is when they want to invest in shares without being clear about their end goal. Wanaingia tu, come up with a figure. You can start small, by the way, don't worry. Say, I want to target like 10K dividends a year, or this year. I want to pay for my holiday using dividends this particular year. I want to make 100,000 dividends this year. When you know the target, it is easier for you to work it backwards to know what is your part to play so that you get to that point. And at this point, Allow me to use an example. For example, if company X has been returning 7 to 10% on average, then it means that if my shares by the end of the year are worth, let's say 100,000, then I'm likely going to get between 7 and 10K in terms of dividends. So my plan between now and the end of the year or by the next dividend season is to make sure I have raised that 100,000 worth of shares. If I don't have the full amount right now, I can still invest the amount that I have already and keep topping it up as I go along. So I can simply commit to following a plan that will get me to where I want to get to. If I had 1 million worth of shares, then I could easily make between 70 to 100,000 in dividends. The other way to look at it is by going the number of shares way, okay? For example, if Kengen usually pays between 0.5 to maybe like 50 cents per share, if I need to earn 10,000, then I need to have something like 20,000 shares, okay? If I need 10,000 bob, then I will also have to have at least like 200,000 shares. You need to do that math so that when it comes to buying shares, you have a target that you are aiming at. Of course, you can't tell how much they are going to pay at the end of the year as dividends, and you can't really rely on past performance, but at least it will give you some kind of idea of what you should have in your possession as the number of shares. A good investor will always do the math and do not rely on guesswork. So now that you have the goal, you know how much you need to have in shares. Then the next thing is to come up with a plan. Do I have the total amount as lump sum to be able to give me what I'm expecting, or I will have to raise it over time? It is okay not to have the full amount, by the way, just like I've already told you right now, and you don't have to reach your goal in 6 months or like one year or 1 month. Sometimes you need to spread out like your plan to like even 5 years, where you are raising your shares from 100 where you are right now to having your 200,000 shares of your company X. Always remember that your focus is to create cash flow and that you have a goal in mind, something that you are aiming at. Remember, you can also break that goal down so that once you achieve the first step, you press towards the second step until your desired goal is achieved. The next thing as you do this is to please practice some patience, because the journey is not always easy, and that is why you need to remember why you started in the first place. Be very, very, very patient. The markets can be very trying and very frustrating at times. There will be those times when there will be no dividends at all. That does not mean that you should now give up and surrender. The other area that needs a lot of patience is when you will be tempted to sell, especially when the value of the shares will be going up. Remind yourself of your target and the goal, and even if you are strongly tempted to sell, unless it is really very, very necessary, please stick to your goal. Going for the income creation requires that you remain stable when markets are going down, and when markets are also going up, don't be quick to sell. Don't be quick to throw away your investment just because you have received a positive growth in terms of your share value at Eco Green. Can I now sell? Be like one of those actual owners of the company. Remember the Mwangi story that I told you, equity? Stick to the goal. And lastly, choosing this path means that your mind should be set that this is long term. You are building your business, my friend. Yeah, you are growing your assets so that it may be able to give you more milk tomorrow or better returns when tomorrow comes. And I think it is okay to say that this is where you actually need to focus on fattening or feeding your cow. And moving over to the second reason why you should get into shares is for wealth creation through capital gains. This is literally growing or multiplying what you already have as the value of the company grows as well. We have already addressed the company growth and how this means more money to the shareholders in terms of return. But as returns also get better, the next thing that grows is the value of the company. This therefore creates another avenue where you can make money from as an investor. Simply put, you get into the company when the value per share is, say, like 10 shillings a share. Then as value of the company grows, it also grows to like 25 shillings per share. And just like that, for every share that you have you own, you just made yourself some 15 extra shillings. So if you had 1 million shares, then you just made yourself an extra 15 million shillings. If you had 100,000 shares of company X, then you just made yourself a cool 1.5 million shillings extra. Isn't that exciting? Of course it is, and this is where the problem begins and why you need to pay more attention to this strategy to succeed in this plan. And to start with, you also need a goal as well. Starting without a goal is very dangerous because, as the saying always goes, every good dancer knows when to exit the stage. For someone going for capital gains, you need to be very strategic, my friend, in terms of when you get in and when you get out. For someone focusing on dividends, theirs is a long-term journey and they can keep going, keep growing when the market is up or down, because their goal is to have more soldiers, yes, actively working, slaves working for you, and these slaves are your money in terms of shares, to give you a better cash flow tomorrow. But when it comes to capital gains, if you are not strategic, you will end up losing your money. What is your target? What do you want to achieve? What kind of growth will make you decide to sell? Yes, you should have these answers. I have said this several times before that this season, right now, is mostly a profit-taking season. And this is for so many investors who bought into the market like 5 years ago to something like, let's say, like 3 years ago, when the market was considered almost dead. Ilikuwa almost dead. And the economy was considered like, hii imekufa, Kenya imeenda. This is why sometimes you should not listen to the politicians and these greedy billionaires, business people that you see everywhere on the news and places like that. Men who during those low seasons were busy telling you how bad the market is, how dead the Nairobi Security Exchange is, like hii Kenya imefinish kabisa, and how things are about to get worse and we are about to lose the country to the Chinese, I don't know to who, and all those other short stories that we were hearing, especially on this little black app known as X. So prices of shares went to an all-time low during those companies, during those moments. A lot of companies were basically selling at peanuts. But then during that time, no one was telling you that it was the best time to buy. It was the best time to get into shares. I did videos at that lowest point asking you to buy, asking people, oh, please, come on, Dunua. Safaricom was at 11 bob at that particular point. And right now, it is at around 35, yeah, or thereabout. And now, there is so much noise asking you to buy shares left, right, center. Oh, shares are the best, telling you that with a lot of speed. What they're trying to create is some demand and causing the value of the shares to skyrocket, creating more liquidity for those that got in while the market was down there low. And when they were getting in, they didn't tell you to join them, but now they're asking you to get in. Yes, kuja shares ndio mzuri, so that they can sell and multiply their money like nobody's business. And you know what, guys? Courtesy of you and me, this year we are going to create billionaires through the stock market. But unfortunately, that won't be you and me, yeah? So now, the question that you might ask, are we late for the party that we should maybe like back down or like avoid investing in shares? Nope. That's not the case. This is where you need to be intentional and get into the shares with a long-term mindset. Yes, after this year we are likely going to see some share prices going down a bit, especially as we are approaching the next general election. But the elections are not the reason. Yes, so the prices are likely going to be dropping because those with big money are going to be pulling it out to cash in on the huge profits. Yes, causing the value of shares to go a bit down. But that again always creates an opportunity to start the cycle all over again. But I'm sure this time around, hautalalia maskio when this happens. So keep your mindset long term, then have a goal. You won't be able to make good returns with just 100 shares or 1,000 shares. You have 200 shares, yes, and the price has doubled from 5 bob per share to 10 bob per share. And now you want to sell all your shares so that you make profit. My friend, you want to cash out on the profits or the growth? Oh, please. If you already have a lump sum amount, maybe that will make sense. And you say something like, I put in 1 million or 2 million and the prices double, so I have made an extra 1 million or like 2 million extra. But if you only put in 5,000 or 900 in the IPO and then it doubles and you say, yeah, I doubled my money. Sikatai, pesa ni pesa, But sasa hizo ndo gani sasa my friend? Are we serious about growth ama ni kalongolongo tunafanya na shares? Like pia mimi niko kwa shares, pia mimi So if like many Kenyans you do not have the capital ready for you to establish real growth, then consider going the gradual growth way, yes? Whereby you start with what you already have now, but then keep buying as you go along. Something similar to what we call keep topping up as you go along. Set a target to buy shares every time that you earn so that you add to your portfolio. Hata kama zina double, hazifanyi nini, and then practice a lot of patience because you will get temptations to sell, especially when you have like 5% growth. Hey, looking good. 10% growth, you go green. Consider you growing and know that I'll be fine if I have like 50% growth, or if the shares will make me like 100k profit, like quite strategic, yes? Something like that. Imagine how someone feels who decided to sell Kenya Power when the price hit 5 bob, and they were so glad that they have sold at the point that the company had tripled its value per share from what they had bought it at. Then here we are. It has more than 10x'd. Yes, like multiplied over 10 times the value that it started at. If you had invested 1 million bob at that point, but was so quick to sell it because it had grown twice the value, then you went home with 2 million. Yet with some patience, right now you could have sold it at 15 times more, which means you could have made or like walked away with 15 million bob extra right now. Do you even need any other example so that you understand what I'm talking about? And finally, remember, when the price drops per share, it is buying time, not crying time, yes? When you see the reds in your portfolio section, it means that it is time for you to buy, because the average per share keeps going lower, and the next time the markets will start going up, you will stand a better chance to gain even better. Please remember, investing in shares should not be a short-term goal and should not be guided by emotions, but by a solid plan and patience. With a good plan, you can actually hack this investment and smile all the way to the bank. Usikuwe emotional hapa. Hebu pumua na hii ingine. Ile nani anasemanga aje? Pressure will kill you nani if you put it kwa moyo. So when you see the likes of ZD Trader being celebrated, hey, my friend, ushapigiwa mahesabu na mabwenyenye out here, and they are smiling somewhere in boardrooms or in their offices, waiting to strike their millions from your little by little mchango. Na unasema, hey, you have invested in shares. How much? Nimeka 500 bob, nikicheki vile kunaenda. Haya, Make sure you are in shares for either reason number 1, as we've already discussed, or reason number 2. Usi waste time and money, and in both cases, please focus. Stop obsessing about this idea of diversification, and this applies in both reasons, whether you are going for dividends or for capital gains. Don't go buying different companies, like give me 10 different suggestions of companies with kidogo capital, yes? Wacha tuambiane ukweli tu, my friend. Shares wanga ni tamu kama you are coming out with good money, kama you have good money invested. And remember, good is relative for everyone. See, at good ni 1 million. Good yako should be the goal. Ati you have 100 shares of Kengen, wakutumia dividends za 45 bob, banki kate 115 bob ya transaction. Surely, who is fooling who now? So please focus and grow your numbers before you start thinking about diversification. But you see, I will be putting all my eggs in one basket. And when you ask them, how many eggs are we talking about? Ati 10,000 shillings. Yes, my friend, sit down. You don't have eggs yet. Yeah, keep feeding that chicken. Let it gather more eggs. I don't mean to insult anyone, but I hope you understand where I'm coming from. Ikitu mazeni personal. I want you to succeed. God wants you to succeed. Thank you so much for watching. Na kama umelan, please let me know in the comment section below. And see you in the next video where the money conversations zitaendelea tu. Na pia usikose kujoin community. Links ziko kwa bio.